Hello and welcome to our Investing for Freedom channel, and I'm Joanne. What is investing? Investing can mean any activity that enhances one's assets. Unfortunately, many are under a false impression that investing is just about trading. Trading is just a very small part of investing. We need to look at the whole picture. Most of us are familiar with the story of goose that lays golden eggs. Bringing the same concept to investing world, goose becomes an asset and the golden eggs that the goose lays is the cash flow. That is why we view making investment is same as running a geese farm. And there are three types of cash flow that the goose brings to the farm. First cash flow is the golden egg that the goose lays. Rent income from real estate or dividend income from stocks are the typical examples. Second type of cash flow is the trading profit that we make by selling the goose. But I don't really recommend focusing on the second type of cash flow because the investor will lose the asset by selling the goose. Especially if you're relatively new to the investing world, we want to focus on accumulating more assets to create more cash flow. If you focus on trading assets, it'll cost you more time and energy to make trading profits, so it becomes almost impossible to achieve time freedom. The last type of cash flow is creating leverage by using the goose as collateral. When the young goose grows into a bigger goose, then the investors can use the goose as collateral and receive cash flow. Many investors tend to think cash flow is only about the first type or the second type of cash flow. But actually, there are three types of cash flows. Corporates use these three sources of cash flow to ensure longer-term profitability and sustainability. We, as investors, should also do the same, and we need to familiarize ourselves with the three sources of cash flow to use them to maximize our profitability in longer term. When our goose brings golden eggs, what do? We consume some and reinvest the rest. When the golden eggs come back into our goose farm, that's what we call investment. And when it goes out of the farm, then it is consumption. There are four types of consumptions. 1. Living cost. 2. Reputation cost, also known as show-off cost. 3. Entertainment, including gambling. And lastly, donations, including tax. Among these four, let's talk about the reputational costs. I struggle to find the correct wording for this, but this cost is sort of maintenance cost, and it also puts more focus on the luxury side. Making investment is more about becoming rich, while the cost is more about looking like rich. If you're actually rich, then you have the freedom to look like rich or not to. But if you're not rich enough yet and you're spending more to look like rich, then it's not going to help you to become a rich. You need to distinguish investing versus consuming and try to focus more on the investing to become a rich. But distinguish investing from consuming is actually not that easy. For example, if you're buying a house, would that be an investment or consumption? Buying a house could be an activity of investing, but living in that house is consuming the house. So investing and consuming happens at the same time when you're buying the house to live in. Let's say there are about 10% of total houses are suitable to invest, while 10% of the total house is suitable for living. Because these two are independent events, probability of buying a house that is both suitable for investment and consumption will fall down to 1%, which means it is extremely difficult to be successful in both ways. So the easier way is separating the investment from the consumption. Focus on making successful investment in-house to get enough cash flow and then use the cash flow to support your living costs. Should you buy the house to live in or should you rent a house? Many people seem to make the decision according to the future prospect of housing prices. But the truth is, nobody can really predict the asset price in the longer term. Rather than speculating the asset price, the better way to do this is to make the decision based on the cash flow calculations. Let's say you have $100K US in savings account and you are thinking about buying a house which costs $200K US. You have two options. You can either buy the property with 50% bank loans or you can rent the house. If you choose to buy the house by getting 50% bank loans, then you're making cash outflow of $100K US because you're giving away all your savings. Plus, you're making extra cash outflow with monthly interest payments. We also need to think about the opportunity cost in this case. For example, if you have the investment skills to make 10% investment return, that 10% return is your opportunity cost of buying the house. If you decide to rent the house, then your initial cash outflow will be less than 100K US dollars. You'll have to pay the monthly rent, which is cash outflow. But in this case, you will have some savings left, which you can invest in other assets to create cash flow. The decision is yours to make, but if you want to become rich and create abundant cash flow, then I suggest to focus on making cash flow while reducing cash outflow. That's it for today. Thank you for watching.